Thank you for this opportunity for allowing me to discuss your health insurance options to your family. And we're going to talk about a lot of limitations that are built in the plans in the marketplace today. And basically what I do is I recommend the best value when it comes to health insurance. I actually buy some of the program we recommend is the program I buy for my own family. And if it's good enough for me, it's good enough to recommend to my clients. So I'm going to walk you through some options today. One of the biggest limitations I like to point out to my clients is the physical therapy portion, because it could cost tens of thousands of dollars, and it's one of the biggest limitations in the marketplace, and it's consistent throughout the carriers. There was a client that had a $78,000 bill in physical therapy, and the most common limitation on most plans is a $3,000 benefit per person per year, and if they were one of those programs, they would have been $75,000 out of pocket from the get-go. So other carriers in the marketplace, they cap out at $600. It's like, thanks, it's just a drop in the bucket. And some will only pay $30 per visit, 12 visits a year. So it's $360, so you're out the window again. So some other carriers in the marketplace has raised the bar to more reasonable limitations, such as they scratched away with the dollar amount, but they left it to a number of visits. So they still put a limitation, but as long as it's reasonable, like for example, 60 visits. If you went to physical therapy a couple times a week, that's about 6 months of therapy. That's usually pretty good. Most people don't go too much longer than that. And if you had a crystal ball and knew you were never going to use like physical therapy, you wouldn't buy health insurance because you don't know what your health history is going to be in the future. And since we don't know, we have to make sure we protect all aspects of the health insurance and make sure you're not vulnerable at the time of claim. Like you and myself and most of my clients, we're self-employed professionals, and we're always looking for advantages to save money on our health care and take advantage of all the tax breaks that the health or the IRS allows us to take. And the program I buy for myself and I recommend to most of self-employed entrepreneurs is what's called a health savings account, or known as an HSA. And the reason being is because it changes the program a little bit, but it lowers the cost of health insurance, and it gives you additional tax breaks by actually opening up a health savings account at the local bank. It's a qualified savings account specifically designed for medical expenses, and you can either go to your local bank or you can shop around and find the best value, because it is interest bearing and other ones have different packages. And the amount of money you put into the program or into your savings account is tax deductible. So you get the deduct amount you put in. For a family, in your case, the most you can put in is $5,800. That's set by the government. And you get the deduct amount that you put in, and now you get to use that money for your medical expenses. So you're basically using money that's already been deducted from your taxes. The government's giving you a break, and they give you a Visa or check card, and you go in and you pay for your medical expenses. In turn for this, they're giving you a lower premium, which will be a lot more stable and more affordable going forward. And it's a combined effort of the deductible. It's one deductible for the entire family. And copays, just to address this, copays, you're paying additional money in your premiums to have copays in the plan. If you actually saw the breakdown of what it costs to have the copays in the plan and how often your family actually go, you might think twice about having copays. Basically, you're paying an insurance company extra money so they give it back to you later, and you're still paying at the time of claim with a copay, whether it's $20 or $30 or $40, depending on the carrier. So by taking these additional savings and putting it into the savings account and your family doesn't use it at all, you're accumulating interest on that money, and it's all tax deferred. So you don't actually have to pay taxes even on that interest rate like a savings account does. And the advantage of this is I always recommend, actually, instead of reimbursing yourself right away for each medical expenses, you're already used to paying for medical expenses, is to just save the receipt like you would do any expenses and reimburse yourself at any point in time in the future. It could be 30 years down the road. And the reason being is because that account is building cash value, so to speak, by the interest rate. And the longer that a balance is high enough, it keeps building more and more for you. So if you reimburse yourself 30 years down the road, as long as you have the receipts to identify those medical expenses, as those medical expenses accumulate, you could actually write yourself a check for a bigger amount and do more important things with it, such as take your family on vacation, or college tuitions, or retirement for that matter. Put it in something of better use instead of giving it extra to the insurance company and then it goes away because you didn't use it. So by taking advantage of the lower premiums and the tax advantages that the government gives, you could bring down your total net cost of your whole health insurance. it's actually a very good solution to the healthcare system to keep your costs lower, especially for families that don't utilize insurance that much. And even if they do, you could still utilize that money that you put in an account that you're getting a tax break from. So the reason I like to recommend this is because of the fact that you get the overall total savings, and in some cases even families, is that with the deductions that you get between deducting your health insurance if you're self-employed and the amount you put in your account, combining those deductions, it might wipe out your monthly premiums or yearly premiums on your health insurance. Like for myself and with me and my wife, we don't have any kids, but for our portion of the premium and putting the $5,800 in the account for family contribution into the account, I'm actually getting a credit on my taxes for my health insurance and the deduction I put in there. So my overall health insurance premiums are very affordable now because it's not costing me anything. And then, of course, we do have a deductible with me, but the money I'm putting in the account can go towards that if I wish and I need to. And if I'm strapped for cash one month, I could actually withdraw money from the account and actually pay it back within 60 days without any penalties. But the carrier I buy my own insurance from, it's actually a 70-year-old company called American Community. And what they did with their health insurance plans, they're one of the ones that raised the bar to more reasonable limitations, like 60 visits on the physical therapy. But the other thing, it's unique. I'm excited about it. I bought it for myself, and most of my clients are pretty happy about it, and they're excited about it, is that they waive the deductible if you have an accident or injury. So, and most of my clients go with the 100% co-insurance option. So, if you waive the deductible and you have 100%, you got 100% coverage for accidents and injuries. You can't beat that. So, little Johnny running around in the backyard, if he breaks an arm, a leg, you take him to the emergency room. As long as you seek treatment within 30 days, it's covered at 100%.